point.
So let me open up a point file here and let me share my screen with you. It's a little slow, so just bear with me. But so this is a refinance. So what on first, the present address, the borrower's current address has to be subject address for refinance, especially if it's a primary refinance. So this is a primary refinance. So his current address and the subject property is going to be the same. Down here, it's going to be a refinance. If it's a rate and term, we're going to click limited cash out. If it's a cash out refinance, we're going to click cash out. Okay. And then the PITI, what they were referring to was this present housing. So this present housing on a purchase, for the most part, is left blank. So right now, because this is a refinance, we're going to complete this present housing. So the way to input this information for the first mortgage, that's going to include your principal and interest. So if you look up for the mortgage statement, or principal and interest, we're going to add them together. So 66292 plus 437236, 5,035 with 28 is your first mortgage. That's our principal and interest. Homeowners insurance, if you get the insurance policy, so this policy is paid yearly, it's annual, right? So we're going to grab the annual month premium, which is 1739, and we're going to divide that by 12 so we can get the monthly income or the monthly payment policy. So this homeowners insurance, let's see if I have. So this should be, not sure if this policy that I just opened up is not the correct one, but this policy is going to match that. And then it should match this right here. So this account, it seems like it's escrowed, 210 for taxes and insurance. Seems a little off here. Let me see. Oh, no, this 210 is a mortgage insurance. So this is not including our escrow taxes and insurance. This is only including the mortgage insurance. So this policy has mortgage insurance, which is the 210 right here. Now the county taxes, when it's a refinance, you have to pull the property profile. If once you run it right here on the second page, the tax amount right here, 7,459. We're going to do the same thing. So we're going to get the tax amount and divide that by 12, and we're going to get our monthly. So 61262. 61262. Okay, mortgage insurance. So the reason why we have a mortgage insurance in our proposed is because our LTV is over 80. It is a conventional, so we have to run a quote for it. So we're going to go to National MI. Have I showed you this page before?
No, I don't think so.
Okay, I'll send you the login information afterwards. But so we'll just complete this quote here. So it's going to be we're going to leave it as single family for PUD. Loan purpose is a rate and term refinance. Loan amount, LTV, are paid, one borrower, 774, self-employed, no. Okay, so then this mortgage here, we have to update it, 15260. And then our HOA, the property is receiving it has an association, so we have an HOA statement here, and they're paying $76. So that's matching to both things. So the reason why our monthly proposed insurance or housing, monthly current present housing is different from your mortgage statement is because this number here is only covering principal and interest and the mortgage insurance. So we're adding homeowners, county taxes, and HOA.
Okay.
Okay. The difference between the present housing and the proposed monthly payments is because the principal and interest is based off of the rate and term that we input on here. So this is automatically calculated. Homeowners insurance is staying the same. County tax is staying the same. Our mortgage insurance, we ran a new quote. So that's why it's different. And then HOA stays the same.
Okay.
Okay. So let me go back to the email. So these two, this right here shows you how to calculate the insurance and taxes. Our REO, page 2 and 3, once you import your credit report, and we have to, on this bottom section 3A, we have to input the subject property, has to be checked off. You put the address, and then you have to complete the value, whether they're selling it, sold, or they're keeping the property, their occupancy. This insurance, tax, and association, this number was all three numbers that we added, the homeowners insurance, county taxes, and HOA. All of that wasn't included in our taxes and in our mortgage statement, we're adding it here. If the account was impounded, we would only add the association here, okay? So once this is saved and closed, on the credit report, if it was impounded, you would just check off this includes taxes and insurance. Because this is not impounded, we're leaving it unchecked off. And now we just have to make sure it matches. So whatever properties we have to match it to whatever mortgages we have at the top. So in this case, this Freedom with this property. If there was more addresses and more mortgage accounts, then we have to verify each one to each property. Okay, and then lastly, on page 7 and 8, page 5, we have to complete this section right here. For purchases, we already complete this. If it's the primary, yes. And then for the most part on a purchase, it's always a no because they're currently renting or they don't own a home, right? So for refinance, because they already own this current home, we have to click yes on number 2 on this second part of question A, and then we have to complete section 1 and 2 of part A. as well. So in this case, he owns this property as his primary residence and he's on title by himself. Any questions?
None so far.
No? Did you understand the part about adding this present housing information?
Yes.
Okay, then. So let me go into, and then I just want to make sure, I think last time I did send you this worksheet, right?
What portion is it?
The worksheet for the income calculation?
Yes, the one I have for the W-2s and the tax return. Yeah.
Self-employed one too? Okay, just want to make sure I did forward it to you.
You forwarded. I don't think I have the self-employed.
I didn't forward this one?
I don't think so. No.
Let me do that right now before I forget again.
Okay.
So this one that I'm sending you is only for conventional loans. For FHA's mortgage insurance, for FHA's mortgage insurance, I have a separate one that I just saved for myself, but it's standard. So any loan amount that it has this loan amount less than this 726,200, and depending on their LTV, we use these. If the loan amount is greater than the 726,200, depending on their LTV, we use these bottom three.
Okay.
Okay. And for the most part, you'll usually use this one that's more than 15 years. But if the loan amount that you're working on is less than 15 years, the rate for the mortgage insurance does change as well.
Okay.
Let me open this up. So last time I had mentioned the different tax returns that we had. I want to say that I had also mentioned that we have the 1065 as well. So we ran over Schedule C, partnerships. No, this is a partnership. This is a 1065 that we're doing. So I had mentioned I think last week we went over the 1120 and 1120S, which were the corporation and S corporations. So now we also have the 1065 tax return for business, which is for a partnership. So when you get the tax returns, the form, again, is going to be 1065. When we rename this, it's going to be 1065 _ the year this was filed for, and then the name of the business. So like all tax returns, we always want to get all tax returns, all pages of the tax returns. So on the tax returns, we want to make sure it includes the Schedule K1. So should be this one right here, Schedule K1. The W-2, so we should have a separate W-2 for it. Sometimes it is included in the tax returns. Doesn't seem like it's included on this one. So like the other two forms that I had mentioned, when we have the K1, it tells us how much percentage they have. So on this partnership, this trust has 84% ownership. There's this other, it's grayed out. I'm assuming the reason is because our borrower is the one that has this trust, but this other partner has 3%. This other partner has 0.39%, and this other partner has 0.68%. And then there's another partner that has 1.8% of the ownership. So all of these partners, there's 7, 8, 9, 10, all these 12 partners, when added, should give us 100%. Okay. So I don't know if I had mentioned before, but for you to be considered self-employed, you have to own 25% or more of the business. So all of these that are less than 25%, they cannot be considered as self-employed, even though they're part of this, they're partners in ownership of this business, because the percentage of them owning the business is less than 25%, they were considered self-employed. Okay. So in this case, our borrower, because they have 84%, they are considered self-employed and we can use their income. So just looking at this is a negative income right here. Most likely, they're not going to have enough money for income to qualify for something, but we're going to calculate the business. Okay, so lines 2 and 3 are complete. Line 4C is empty as well. So same thing, we just go follow what our Excel is asking for, and we're just going to input the information. Our W-2, since we don't have the actual W-2 form, if we look up the first page, so this 10 would be the guaranteed payments to partners, would be our W-2, which is blank. So now we're going to complete this form 1065 going based off of this. So line 4, 5, 6, and 7. So let's add. 5 is 0. 2, 6, we have negative 18,114. And we're going to add 2,034. So then here we're going to put negative 16,080. So every time you put a negative, if you can see, it's going to be red and it's going to be in parentheses. That means it's negative income. Okay?
Yeah.
16C, 14. So we need to look for form 8825 actually before we add this. So as you can see, this is line 14, depreciation from form 8825. This taxes and insurance is not our depreciation. So this has to stay blank if we don't have this 8825 form, which we don't. So it has to stay blank. Now line 17, it's blank. Again, amortization, we're going to look at statement 2. So we're going to scroll down to the statements. Statement 2, amortization. Do you see this? So we're not using the full 308. We're only using this 11,000. Okay, we're going to go back to our form and we're going to look for Schedule L, line 16. L, 16, it's blank. And so M1 for B, Now let's look at 2022. Oh, sorry, I didn't put our percentage in 2023 here. Based off of this, it was 84. So 84.4.
Where did you open the 84.49?
Right here
Oh,
on
okay.
our schedule, K1, the percentage that they own.
Yes.
Okay, 449. I'm putting 49 just to round this up. Okay.
Okay.
Now going back to 2022, our K1, again, it's a negative. They're all blank, 5, 6, 7. They're all blank except 7. So we're going to add 120, 16C here, 14. If we had an AA2 form, it would all show like up here the number 8825. So because we don't have an actual form for that, that stays blank. Line 17 blank. Number 20, statement 2 are other deductions. It's going to be, this doesn't have the line number where it's supposed to be, but anything that's other deductions, we need to look again at the statement attached to the file. So let's scroll down here. Statement 2. Again, we have amortization, 335. Schedule L, line 16. L16 is blank. M1, 4B, nothing. And then going back to our percentage of partnership. So it's going to be 9256. So when we look at the income, it's averaging, it's adding all of the income for each year for all 3 different sections. And then this plus this average, should divide that by 24 months. It should give us this much. But because it's a negative income, this income for this business, it's a no-go. We can't use this. Same thing goes as if this was all positive income and this number is greater, 2022 is greater than 2023, we can't use 22 income, and we need to make sure that the business has been open for 5 years so that way we can use 1 year income. Any questions?
And then for now.